Wells Fargo to pay $3.7 billion for widespread mismanagement of auto loans, mortgages, and deposit accounts.
Wells Fargo is one of the oldest and most reputable banks in the United States. Well, maybe not so reputable anymore because of the things we're going to discuss in this video. Welcome to Unpopular Opinion. We all know that Wells Fargo has built its reputation over time by loaning out financial services to people and businesses in need. However, Wells Fargo's reputation today is in tatters, following several classes of scandals, with the most recent one being duping customers. The bank is involved in what seems to be the situation that will break Wells Fargo's camel's back. So what is this scandal, and what are the previous ones the company had been involved in? Watch on to find out. The rise of Wells Fargo. Wells Fargo is an idea of two American entrepreneurs in the 1980s, Henry Wells and William G. Fargo. The two men are also the co-founders of American Express. Wells Fargo was founded in 1952 precisely. The period is the middle of the technological revolution, where trains, canals, and stagecoaches serve as the means of connection between economic communities. The need for secure ways to send payments and reliable places to get money, especially while on a journey, grew. And it is this time that Henry Wells and William Fargo came up with the solution that breeds Wells Fargo. They acted as agents between their customers and the other parties during the transaction process. With this method, customers were no longer wary of conducting business with distant partners. The California gold rush during this century was a great catalyst for the success of the bank. One of its earliest and most significant tasks was the transportation of gold from the Philadelphia Mint and express mail delivery, which was faster and less expensive than U.S. mail. By the end of the California gold rush, Wells Fargo was a dominant express and banking organization in the West, making large shipments of gold and delivering mail and supplies. It was also the primary lender of Butterfield Overland Mail Company and later acquired the company in 1860 due to the failure of the company to settle its debts to it. It became a federal banking charter in 1968, making it Wells Fargo Bank, N.A. In that same year, Wells Fargo merged with Henry Trion's Sonoma Mortgage in a $10.8 million stock transfer. This deal makes Trione the largest shareholder in Wells Fargo until Warren Buffett and Walter Annenberg surpassed him. In May 1995, it became the first major U.S. financial services firm to offer internet banking. During the 1980s and 90s, Wells Fargo was involved in a series of acquisitions. It acquired Crocker National Bank from Midland Bank, the personal trust business of Bank of America, and Barclays Bank of California from Barclays plc, among others. The bank itself was likewise acquired by Norwest Corporation of Minneapolis, but the name Wells Fargo was maintained. From the mid-2010s to 2020, the bank underwent a wave of selling its properties. All 52 of its physical bank branch locations in Indiana, Michigan, and Ohio to Flagstar Bank were sold. Their operation and services include consumer banking and lending, wealth and investment management, international operations, and a key part of it, which is cross-selling. The scandals. The most recent scandal of Wells Fargo was over the perpetrating of illegal activities, which include wrongful foreclosing on homes, illegally repossessing vehicles, incorrectly assessing fees and interest, and charging surprise overdraft fees, according to the Consumer Financial Protection Bureau. The misconduct leads to the resurgence of the scandals Wells Fargo has been involved in since 2016. This 2016 scandal revolves around the fake account, whereby Wells Fargo created about 1.5 million fake deposit accounts and more than 500,000 fake credit cards, all in customers' names, but without their authorizations. This led to a national brimstone, and the issue was settled with a fine of $185 million levied on the bank by the Consumer Financial Protection Bureau, the Office of the Comptroller of the Currency, and the City and County of Los Angeles. Due to the incident, 5,300 low-level employees were sacked for creating these accounts under extreme sales pressure. Academic research had shown this kind of sales pressure was known to cause similar issues at large banks. The then CEO, John Stumpf, also followed the incident and had to make a compensation of $41 million. In a class action lawsuit, Wells Fargo agreed to pay $142 million to the affected parties, which included millions of consumers. They also made a statement about putting an end to unreasonable sales goals. In that same month and same year, which is September 2016, Wells Fargo was once again slapped in the wrists by the Department of Justice.
I am deeply sorry that we failed to fulfill on our responsibility to our customers.
This time for improperly repossessing the cars of the members of the military. The improper repossessing crime entails a failure to limit interest rates to 6%, as mandated by law. Failure to disclose to the court the state of the borrowers when it asked for eviction, and failure to obtain court papers before repossessing the cars. In the end, the bank ended up paying $20 million in fines to OCC and compensating the wronged service member with $10 million. The bank was involved in another scandal in 2016, but in a different month, December. Due to failing a living will test, U.S. regulators limited Wells Fargo's ability to grow. The living well test is carried out on big banks to know how they would unwind in the event of bankruptcy. The list of their scandals doesn't end in 2016. They brought it to 2017. In March 2017, Wells Fargo was involved in another case of fake accounts. This time, the fake accounts numbers were 1.4 million higher than the initial estimates of the first scandal. Meanwhile, Wells Fargo first said the number was unverified and hypothetical, but it later said there may be up to 3.5 million accounts. In March 2017, Wells Fargo failed an OCC test for community lending, getting a need to improve. The test is to promote lending in lower-income communities. The regulator cited the reason for the failure, which are violations across multiple lines of business within the bank and significant harm to customers. In April 2017, Wells Fargo was ordered by OSHA to pay $5.4 million to the bank's former wealth manager that was fired in 2010 for reporting potential fraud to a hotline and reinstate him to his position. The bank faced another issue in August 2017. It was sued for allegedly overcharging small business retailers for credit card services, hitting them with a huge termination fee and a 63-page fine print agreement that hid terms from small retailers, somehow deceptive. Regarding the contract, a former employee told CNN Money that God would have had a hard time escaping the contract, and that the employee was told to target mom-and-pop shops without legal support. Meanwhile, Wells Fargo denied the allegation, but it was found guilty by the court and fined $37 million. Not only did the U.S. regulators limit the size of Wells Fargo, but the Federal Reserve also released an announcement that it will restrict the bank size in February of 2018 as a response to widespread consumer abuses and compliance breakdowns. In the same February, the bank was sued by Sacramento over discrimination against Black and Latino borrowers during the lending process. The lawsuit was dismissed in 2022. In March 2018, Wells Fargo was ordered by the Justice Department to investigate its wealth management business. The bank said it was investigating whether there have been inappropriate referrals or recommendations within its wealth and investment management business. Furthermore, in April of that same year, the bank was alleged of charging people with car loans for insurance without their knowledge, even if they had been insured before. The bank had also charged customers for extending mortgage rate locks, even if the bank was responsible for the delay. An agreement of $1 billion was reached by the bank, the CFPB, and the OCC to rectify both issues. In May 2018, their crime was an alteration of business information without the client's knowledge. It was reported by the Wall Street Journal that the bank's wholesale banking division altered business information like social security numbers and dates of birth without the client's knowledge. Meanwhile, during the fake account scandal, investors claimed the bank knew about the fake account issue, but failed to disclose it to investors. The bank was charged with securities fraud allegations, and it was settled with the bank's payment of $480 million. They faced 5 more scandals in 2018, which includes improper representation of mortgages to investors during the housing bubble. Most of the cases were settled with the bank's payment of cash. In 2019, Wells Fargo was among the advisors sanctioned by the SEC for fee disclosure practices. This is a brief look back at Wells Fargo's scandals over time. With all these scandals following each other sequentially, Wells Fargo was termed a repeat offender by the CFPB's chairman, Rohit Chopra, and the possibility of the bank surviving the recent allegations, even after paying a record fine of $1.7 billion, is slim. The Wells Fargo rinse-repeat cycle has harmed millions of American families. Guys, I don't know about you, but if someone is doing wrongdoing many times repeatedly, I would not bank with them. What I suggest you do is to keep an eye on my next video about how the American economy is about to do something it was never designed for. See you in the next videos.